Here we go. So, guys, good morning. Thank you very much for joining us. Freedom Team, it is good to have you here. If you are a guest with us, welcome. You're always welcome. We do this every Tuesday. We've been doing this now for, gosh, coming up on 3 years. Hundreds of these now, well, several hundred of these now in the recording. That you can always go back if you're part of EXP, part of Freedom Team. You can go to our workplace group, click on the Learning tab, and you can see all the recordings in there. Everything is there. So it's good to have you guys. So this morning, guys, we got Ramon. Am I saying your name right? Casaus? Am I saying that right?
Yep, you got it.
I got it. There you go. Ramon Casaus. So out there in Scottsdale, Arizona, we were just talking about that. It's still hot out there. But Ramon, let's see, 2,500 homes in the last 6 years that he sold. So he is a busy guy. He's built teams all across the Southwest, just reading some of his stuff here. He was actually number 299 out of all 100,000 real estate teams in 2023. Top five largest independent brokerage merger in company history. He helped orchestrate that with EXP. But how long have you been at EXP, Ramon?
I've been at EXP since 2020.
Okay.
Yep.
Very, very cool. How long you been in the business?
Since 2016.
2016. Man, you're crushing it. So,
Appreciate that.
Yeah, you are killing it here. So anyway, we're going to talk about seller financing. Ramon's taught some classes in EXP University and stuff, and I saw that and wanted to get him in here just to bring him in and teach us. There's all kinds of ways we can just, ramp up production, just get more deals, get creative. You got to get creative a little bit in this market sometimes with some people to kind of keep things going. So things are always in flux, always changing. Ramon is doing well. He's ahead this year from last year, barely, but I think even if you can be break even same on this year compared to last year, you're doing phenomenal. So many agents are just down right now in their business in terms of what they're doing. So anyway, Ramon, we appreciate you being in here. Thank you so much for your time. I know you benefit in no way, shape, or form from coming into our group. It's one of the great things about EXP is the way everybody works together, that collaboration piece. So we appreciate you being here. So man, why don't you take it away? I got my notebook and my pen. I'm ready to go. So
sounds good, man.
Thanks
for the intro, but I would have to disagree with you on the benefit no way, shape, or form. I've learned that the real estate industry is pretty small, and I mean the people that I've met on Zoom calls and later years down the road did deals with or some type of mutual connection. It's always it always surprises me. So definitely great to meet everyone, and hopefully we can stay connected and whatnot. So thank you for letting me be on your call. We're going to talk a little bit about seller financing. We're going to talk about really what seller financing is and, the kind of the greater word right now, creative finance, and how you can leverage that in your sales business. I think the flip side is I learned seller financing, and 80% of my personal portfolio is all seller financing transactions. And when I first got into the business, it was funny. I thought everyone owned real estate. Like I thought that was normal, where everyone had, 10, 20, 30 rental units. I was like, how would you not? Right. And I soon found out pretty quick that wasn't the case, and found out there are some pretty specific reasons why. And so somebody sat me down one day and said, hey, look, if you want to buy real estate and you're a real estate agent and you don't want to pay taxes, but then sometimes you might not have 2 years of income and blah, 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 blah. This is a very creative way that you can acquire real estate on a regular basis using this method. So as much as I think about this method as a way to additionally serve and bring options to your clientele that may be in a sort of a predicament, I'm going to show you a real life example of one that we're doing right now. I also think like these are phenomenal opportunities for you to look at a deal and say, can I buy this? Should I buy this? Does this fit my buy box? And some of the deals with interest rates or down payments or call dates, it's been pretty wild what we've been able to do over the last 5 years with seller financing. So I'm super excited to share this with you. I'm going to share my screen real quick. Can you guys all see this okay? Basics of creative financing. All right, cool. Let me put the full thing on here. One sec. There we go. Cool. So real quick, just give you a couple things that maybe Jeff didn't say, but yeah, I have a real estate sales team in Albuquerque, New Mexico, in Phoenix, and a small team in Denver. So we started out in Albuquerque. That's where I started my independent brokerage when I was 24, Rock Real Estate Partners. You should not be allowed to start a brokerage at 24. That should be illegal. There should be some type of like age limit, like a driver's license, same thing. Like however that happened, it happened. So that was fun. And what I do now is I run our sales teams across our different markets. I actively invest in real estate, and I like to do cool things like, I don't know if you guys have seen Broke Agent Media or The Broke Agent on Instagram. Anyone seen that? They make hilarious content for real estate. Yeah. So the founder of the company, we're good friends, and I'm a content creator. So I'm trying to get better at the online lead generation, YouTube. So I do a lot of real estate investing content with that company. And then one of the other really cool partnerships that we ended up securing in 2022 was we ended up partnering with Place. If anyone's ever heard of Place, it's a pre-IPO real estate technology platform that partners and powers top 1% real estate teams all across the United States. So that was super fun. We've learned a lot there. But yeah, that's my day. This is my normal day. This is what it looks like, and then some seller financing deals to review and hopefully buy. So why are we talking about seller financing and creative finance in general? As you know, it's a buzzword on social media, right? Everyone's talking about creative, right? Buying deals creatively. Tons of new investors have entered the market because the low barrier of entry, sometimes that this creative financing, it presents a low barrier of entry. So whether someone's talking about subject to seller financing, Section 8, these are easy ways to get into deals. You may be receiving, and most likely are receiving, creative finance offers on your listings, right? I don't know if you guys, anyone's getting the automated now, right? A lot of automation is happening now with offers where you're just getting offers that are already, as soon as your property goes on the market, there's predetermined offers that are being sent to you. Most all of them are some type of creative finance offer. You might have an investor that you're working with that may be looking at investing using seller financing. You may want to utilize creative finance offers for personal purchases. Highly recommend that. And overall, you just provide more value to your clients when you're well versed in all types of financing, including creative financing. So what is creative finance? Let's just start there. Creative finance, long story short, is any non-traditional way to purchase or finance property. So that word itself just encompasses anything that would be considered non-traditional financing. And now that's a rabbit hole you can go down, but we're going to talk about the big two right now that are really popular, but we're going to dive into seller financing specifically. So hold on, let me move something here. Cool. So again, I think what you're going to take away from today when we're talking about seller financing is not typically used for a majority of your purchases, right? For your clientele, buyers and sellers, like it's probably 1 out of 50, if that, maybe 1 out of 100. However, because of the drastic ups and downs that the market has experienced, we're running into a lot of situations where seller financing actually could make sense for your seller. And I think it does, and also can make sense for the buyer, but particularly for sellers. So having the ability to accurately explain these types of deals separates you from the competition. I'll be 100% honest. The biggest hinder to me getting seller finance deals across the finish line is another agent. Like, as bad as that sounds, it's always because they conceptually aren't able to really explain the pros and the cons to the seller or to the buyer in a professional manner, in a clear manner. So, and the other side of this is as time goes on, there will be more strategies that emerge and become relevant again. Like a lot of this stuff is cyclical. Like seller financing is and subject to are not some, brand new concepts that just came out of nowhere in the last couple of years. These have been happening, but because of how the market is shaped, certain strategies work really well with certain markets, right? So this is why seller financing is becoming a lot more popular, as well as all creative methods right now. So more tools in the tool belt, as I like to say. All right, so I threw around these terms. Let's just establish a clear difference because I see these getting mixed up all the time. There's seller financing and there's subject to. Okay. There's a couple of distinct differences here. Okay. So seller financing, which I've done seller finance and coach seller financing across a ton of different markets. Seller financing is like the word that everyone understands, but I've seen it referred to in some markets as seller carryback, seller carry. Some people just call it terms. You'll like this one. In New Mexico, they call it real estate contract or REC. I'm dead serious. They don't say seller financing, they say an REC. Owner financing. I've seen some markets where they say, is the owner willing to hold paper? But all of those really mean the same thing. But that's seller financing. Subject to is commonly referred to incorrectly as assumption. Incorrect term. It's not an assumption, but people will relate it to that. Sub to or takeover payments. These are all key words that mean subject to. And so I'm going to explain the differences between these, then we're going to get into the seller finance, but it's really important to know this distinct difference, okay? So seller finance is a seller financing agreement where the seller handles the mortgage process rather than a traditional institution. Okay. So rather than a buyer obtaining a mortgage from a traditional bank, the buyer enters into a mortgage transaction with the seller. Okay. Now, but pro tip here to understand clearly the difference between subject to and seller financing is seller financing, the parties come together, negotiate terms to make a new payment. Keyword here, new payment. Okay, so you negotiate, the down payment, the interest rate, the purchase price, the amortization, the call date, etc., and you create a payment on that property that the buyer now owes the seller. Okay, now I'm going to fast forward through here, and I'm going to talk about subject to now. Okay, so you can hear them both right after one another. Subject to is when an investor or purchaser takes the right to the title for a property while the seller's existing mortgage stays in place. Okay. So subject to, the buyer continues to pay the seller's existing payment. Keyword, existing payment. Okay. So the easiest way to understand the difference between the two, seller financing, we create a new payment. Subject to, we use the existing payment. Now I'm going to stop there. Does anyone have any clarifying questions? That's maybe something that popped up in your head with those two distinctions, Jeff?
Anybody, guys? Does that make sense to everybody? Questions? Anybody? Two different things: new payment, existing payment.
Yep. Yep.
Right.
No worries. Just want to make sure
Cool.
because I see those getting mixed up all the time. And understanding what now there's some other nuances, but that's the main difference that I want you to take away. Okay, cool. So let's just real quick, again, for the sake of driving the point home, so we're all on the same page when we say, what is a seller financing transaction? So let's just say that Jim has his realtor. Jim's realtor is Deborah. Jim wants to buy this house right in the middle. Judy is the seller, and Judy's realtor is Glenn. So Jim traditionally would go to a bank and say, Mr. Banker, right? Mr. Loan Officer or Mrs. Loan Officer, what do I need to do to get a mortgage? And the bank's going to say, you need to do X, Y, Z, right? You're going to need 25% down or 20% down or 10% down or 5% down. We need 2 years tax returns. We need, 12 months of bank statements, a hard credit check, 650 or above, whatever the case is. So the same exact way that the buyer goes to the bank, now Jim is going to go to Judy directly and say, Judy, what terms do you need for me to purchase said property? Okay. And so Judy's terms to Glenn are a $400,000 sales price. Judy's a smart one. She wants 20% down. She's not playing games with Jim. She wants 20% down. She wants a 7% interest rate and she's going to amortize the loan over 30 years, and she's going to give Jim 5 years to either refinance or sell the property, aka pay back Judy in full. Now, in these transactions, I highly recommend, and we'll get into do you have to or not, but I highly recommend it goes through a title company. Jim is going to take actual title ownership of the property. And then what's going to happen after that is we're going to use an escrow or a servicing entity, which is, long story short, a third-party accounting firm that keeps track of all payments in this arrangement between Jim and Judy. Okay. So this is kind of a visual here of how these processes work. And if you think about it, the only component not here is the bank, right? Everything else flows exactly the same way. But with the bank, again, there's no underwriting. If you're self-employed, they want usually 24 months of bank statements, and they want it from every account that you're on. They're going to want a hard credit check. They're going to need to source all of your down payment and funds, right? There's going to be a appraisal, and they need to know who your third grade teacher was and what size shoe you wear, right? Like, that's the only part that's missing out of this arrangement. And oh, mind you, usually around 3% of lending fees in addition. So this is why, for those reasons, a lot of times the buyer and the seller making a deal directly can be more advantageous for both parties. All right. So commonly asked questions about seller financing. Are agents still compensated? Absolutely, 100%. Especially on the buyer sell side, agents are always compensated. That's normal. That's business as usual. Do you have to use a title company? Technically speaking, Jeff could sell me his property on a napkin right now, and I could buy it from him, and that's my proof, right? Like, I don't have to use a title company. However, I would personally not do a seller financing deal without using a title company. Do you have to use state forms? Technically, no. You could write up a purchase agreement on a blank piece of paper and take it to title, and they'll do the deal. However, for brokerage and E&O insurance purposes, I would highly recommend using your state forms, and all state forms should have the ability to process a seller finance transaction. Who creates the terms? Well, luckily, that's one of the beautiful parts about seller financing. It's all 100% negotiable. Every last term of the deal is negotiable. So the buyer and the seller, long story short, they make the terms. Are inspections required? Nope, they are not required at all. However, I highly recommend, if you're representing a buyer or yourself, that you get a home inspection on any property that you plan to purchase or help somebody else purchase. Is an appraisal required? No, it is not. However, any party has the ability to do an appraisal. However, it's not a requirement of a seller finance transaction. Who services the loan after it closes? This is going to be a servicing company, and people call either servicing or escrow servicing. I would not personally do a deal without utilizing a servicing company after the fact. I wouldn't do it personally. So highly recommend that. Does a property have to be owned free and clear? No, it does not have to be owned free and clear. However, you must know that on every single mortgage, I mean, almost all of them, residential mortgages, there is what's called a due on sale clause. Everyone familiar with that clause? Due on sale clause, meaning you cannot transfer the rights of ownership to this property without paying off the first lien holder, aka the bank that loaned you the money to buy it. So if there is a mortgage on the property and this person sells this property on seller finance, technically speaking, they are violating the due on sale clause of their mortgage. Now, there are many arguments out there, and this is a huge gray area in the space. Does the bank care? Statistics show it's about 1 in 1,000 times the bank will actually care. If they're receiving their payments on time, usually there is no issues, but 1 in 1,000 properties that you transact, there could be an issue. That's the statistic in the industry that we see. But you got to know that technically speaking, your seller is violating the due on sale clause if there is a mortgage in place. Um, what is a call date or balloon payment? This is where a seller has to pay off, excuse me, a buyer has to pay off the seller in a certain amount of time. Now, we have done transactions where we get a 30-year note. So I buy Todd's house and Todd gives me 30 years to pay off the loan. We've done that before. Now, Todd might say, "Hey, nope, Ramon, I want to buy another house pretty soon. I need the money. I can give you 2 or 3 years max." But again, it's all negotiable. But a call date or a balloon payment is when you must pay off the total balance of your loan at a predetermined time back to the seller. How does the seller qualify the buyer? Um, the seller qualifies the buyer however they see fit. I will say that I would say 80% of the time, the seller doesn't ask me for anything other than a proof of funds for the down payment. Now, I don't condone this, like no qualifications needed. I don't condone this at all, but it's up to the seller on what makes them feel comfortable. So those are some quick commonly asked questions about seller financing. Anything that I can clear up here or might we want to touch on, Todd?
Yeah, I got one question. I've kind of heard this gray area about the due on sale clause. And so it'd be nice to hear your perspective on like when we say, okay, we're technically violating, but no one seems to care. Maybe 1 out of 1,000 times a bank cares. Is that like illegal, or how do we understand what's happening? Because it seems like pretty much everybody's okay with it, but what's really going on there legally?
Yeah, well, I mean, legally, right? There's an agreement. There's an agreement between the mortgage company and the buyer, right? Now, that in itself is not necessarily illegal, but it is violating an agreement that you have, right?
Hmm.
And in said agreement, the mortgage company does have recourse. Is it actually illegal? No, but you are violating what is in your agreement that you have with said bank. So there's a couple different ways that you can kind of get a due on sale clause, maybe expedited, right? Like you don't want one, but here are some ways that it could happen. One, sometimes the buyer or the seller, without knowing, sometimes will call the bank and tell them,
Hmm.
just thinking that because they don't know the deal, they'll call and tell them. However, I have seen people call PennyMac. If anyone's familiar with PennyMac, I've been at the kitchen table where somebody calls PennyMac to say that a property had been sold after the fact on a seller financing transaction. And I saw PennyMac say, "Cool, we'll put it in our back order, but just so you know, they're probably never going to get to it or care." And I'm like, "Oh, okay, interesting."
Hmm.
So I can't say that for every single bank, but I can say that that has been my experience quite a few times. As long as the bank is getting paid on time and the insurance is still in the original, or an additionally insured is still in the additional note in the initial purchaser's name, they're either additionally insured or they still have a policy. I haven't seen it cause any issues, like the bank's not reaching out.
Hmm.
Ramon,
Yep.
uh, my name's Steve Carruthers here in Colorado Springs. I've done probably, I don't know, at least 25 of these type transactions. Most of them, though, in the early 2000s. Uh, and I can echo everything you're saying. We did a lot of subject twos. We did wraps, which is a different type of basically the same thing, but I would just take over writing the check, making the payment to the bank on my check. Uh, they would. I never had one say a bank say anything. They really don't care. All they want is their payment.
Yep. Pretty accurate.
So
Pretty
the
accurate.
Ramon,
buyer is paying the seller. The new buyer, the buyer who bought the house is paying the seller on the terms that were created there.
Yep.
Seller continues to pay the bank on
Yeah. Well, so so there's two types, right? There's free and clear seller financing transaction. There's a transaction with that has debt on it currently. So this is why I always recommend the escrow company is let's just play the scenario where there's a loan already on the property. Okay. So the servicing company, Jim buys Judy's house. Judy has a mortgage, right? So when we engage the escrow company, what'll happen is Jim's payment will come into the escrow company. Escrow company will pay Judy's mortgage. The remainder will go to Judy if there is a remainder. So that's why the third party firm is so important, is because they ensure that Jim's funds don't just go to Judy and Judy say, well, I'll pay my mortgage whenever I feel like it, right? The funds go to the servicing company. The servicing company pays the note. And if there's anything left over, that goes to Judy.
Got it.
Would the analogy kind of carry over just as a rental agreement in the sense that a tenant agrees on the contract to pay the owner rent every month, but if someone else, a friend of theirs, starts paying their rent, no one's going to care. But if the owner found out someone else was paying it, maybe they could do something because they have a contract. Is it pretty similar to that?
I mean, yeah, I guess there's probably a lot of nuances in that, but somewhat, I guess. I mean, I
Okay.
would say that there's some similarities. Um, I think the difference in the seller financing deal is that the person has now, like, in that tenant agreement, the tenant has given the other tenant who's paying, has given them legal rights to the property. That's the difference. Because in a seller financing deal, right, the initial buyer has rights to the property, but when they go do a seller financing transaction, they're actually transferring the title of ownership to somebody else.
Sure. Yeah. I guess just from a legal perspective, it's like, it's like, well, the agreement is with the renter to pay. But if someone else pays, as long as the owner's getting paid, typically they're not going to care like a bank. Just from
Typically,
that
they're
perspective
not
is all
going
I'm
to,
saying.
yeah.
Yeah.
Typically, I could care less where the money comes from. If someone of my tenants, awesome.
Exactly.
No,
Cool.
no problem.
All right.
Okay.
Thanks.
All great
So I
questions.
had a question, and if you covered this in the beginning, I missed it. What's the benefit of the seller for doing this financing? Is this if it's just been sitting on the market for a minute and they can't get it sold, or what's the benefit for the
Yeah,
seller?
great question. So I'm going to show you here in a sec. I'm going to show you an actual transaction, real life happening right now. And this is a very common situation. It's a low equity situation. Okay. And I'm going to show you that. Now, the flip side is let's just play a scenario where Judy here owns this property. Okay. And she owns it free and clear. There's no mortgage. She owns it. Okay. So a couple of the benefits that the seller gets to take on by selling their property on seller financing is, number one, the biggest one is the principal and interest, right? So when you actually look at an amortization schedule and you look at a 7% interest rate, it's an astronomical amount of money over the next 5-10 years. Okay. So now Judy is collecting that interest on top of the principal pay down. So the amount of interest that accumulates over the time that Judy holds the note, it's a significant number, assuming her rate is somewhat advantageous, right? But even at 2-3%, it's still a lot of cash. So that's number one. Number two is that Judy now no longer has any liability to the property. She no longer has to pay the taxes, technically doesn't have to keep an insurance policy. If she had tenants, no more tenant calls, no more maintenance, no more nothing. The property has actually changed hands, and now she is just holding on to a promissory note, collecting principal and interest. So it's a very, very nice lifestyle play for someone who's just tired of managing their properties. If Judy owns this property and she owns it for $500,000, let's say she gets $500,000 house free and clear. Okay. Well, if Judy was to take on this property, sell it and get $500,000 in cash, what is she going to do with it? Right? And that's one of the things that happens if you're an investor and you want to keep making returns on your money. It's like, well, shoot, if this investment gives me $500,000 back, I got to go figure out how to redeploy it. So in this scenario, right, instead of having to figure out how to redeploy it, Judy is now making 7% on the total equity that she has. She's now making 7% return annualized, completely passive on a potential $450,000 balance. So that's very attractive. The other side is that if you are a more sophisticated investor and you've kicked the can down the road, if you will, with cost segregation studies, accelerating your depreciation, right? You got a pretty big tax bill coming up. So this is an easy way to kind of space that tax bill out a little bit. And what can happen, Kathy, is that the seller, if they sell this property and they have a net gain on the property, that net gain can actually put them into a higher tax bracket that year. So this helps them keep them in a lower tax bracket for that specific year. So those are just a couple of the benefits, if you will, of why that could be advantageous for the seller.
I can see it more on somebody that owns it outright versus somebody that has a mortgage on it.
So there's a funny saying that goes, subject to is for pain and seller financing is for gain. So the seller really does, in my opinion, assuming this fits their needs, they can really gain and capitalize on a seller financing transaction. In subject to, which is almost, well, in order for it to be a subject to transaction, they have to have a mortgage. Those are more pain situations. So Kathy, I think you're right. A lot of those situations are not necessarily, oh yeah, I have a property, I have a mortgage, let's sell it on seller financing. There's usually more complications to that, and there's probably some level of pain that's going on monetarily speaking that we're helping solve by being creative with that type of transaction. So I think you're, for the generally speaking, probably pretty accurate with that. Cool.
Makes
These
sense.
are great. Any other questions? Okay.
I have a
Well, I
question.
gotta
Sorry.
say- oh, go ahead.
What happens if, well, two scenarios. One, you're the seller financing this, and the buyer A decides to not pay, or B, they let the home be run down, or a combination of both.
Great question. So in every seller financing transaction, most of them, there's going to be a foreclosure clause, just like there is in a mortgage. So the seller would have to, unfortunately, go through the foreclosure process, which can vary state to state. However, they do have full recourse and legal right to regain ownership of the property if their buyer defaulted. This is also why having a servicing company is so important, because if we don't have a servicing company, what if the buyer says, oh, I was paying you in cash. Don't you remember, Jeff? I was bringing over the money to you every time in cash at your house at XYZ Street. So if you don't have a third-party accounting who's keeping track of all said monies in the transaction, dates, amounts, times, form of payment, right? It might be a little bit harder to foreclose on somebody who is going to give you a hard time. So that's one. Two, let's go back to this scenario real quick. And this is a risk that every seller is going to take on selling on seller financing for sure. So if I'm Judy in this deal and Jim is buying the house, right? I'm telling Jim I want $80,000 down. Okay. So remember, if you stop making your payment on this deal, I have your $80,000 down payment. And I also have all of the principal interest payments that you made to me. I collected all that interest. And if you foreclose, I can take the property back. However, let's just say the property's trashed, just like you mentioned. Well, I have to do somewhat of a calculation in my head. A, did I qualify the buyer? Did I actually look at your credit report? Do you have evictions? Do you have money problems? Do you have a ton of credit card debt? These are all telltale signs, right? Do you have a criminal record? I mean, these are all things that you want to take into consideration. And then for that risk, whatever that profile shows, for that risk, how much money down do I need to feel secure that if in fact I have to take this property back, I'm not going to be losing on the deal? For example, if I only took $10,000 down on this transaction and you trash the house, it's probably going to cost me a significant amount more than $10,000 to A, fix the house, and B, go through the foreclosure process, right? So it's kind of that balancing act of what's the risk? What do I need to feel good about the risk from the seller's perspective and how you negotiate the terms? Does that make sense?
Yeah, that makes sense.
Great question.
It's good. Svetlana, you have your hand raised. Can you open your mic? You have a question?
Yes, thank you so much. Quick question. Would you be so kind and tell me, can the new buyer pay off agreed amount earlier to the servicing company? For example, in terms and agreements, it agreed to pay off on a 7th year balloon payment and monthly payment such and such.
Yes.
Can they prepay and how to do it? So it will not
Yes.
go, how to do it?
Yeah, they can. And there's three ways you pay off a seller financing transaction as the buyer. A, you sell the property, right? B,
Mm-hmm.
you refinance it with traditional lending.
Mm-hmm.
C, if you have the cash, you can pay off the total balance. Now,
Anytime, not necessarily 7th year, right? To save on interest.
yeah, correct. However, there's a caveat to this though. So this is kind of where this legal disclaimer comes up because I have to say that every state is a little bit different. Okay. How they recognize prepayment penalties. Like, for instance, if anyone's familiar with DSCR financing, debt service coverage ratio, many of those loans have a 5-year prepayment penalty. Most of them do. However, there are some states in the US that do not allow prepayment penalties. So this is why with seller financing, it's important to whatever market you're doing business in to get familiar with the state laws for that particular type of transaction and any EXP's policies of creative finance in those markets. So, but yeah, it can vary, but technically speaking, there should be no issue most of the time paying off your note early.
Okay, great. And second question, if I may. So I'm looking for my clients and myself just on the deals on MLS, and they do advertise seller financing, and a whole kind of reason for my buyers to look that direction because rate is lower. For example, I don't know, 285, 399, 3.5 instead of the market rate. But then in that case, seller will not gain additionally anything on the interest. They will just get market value of the property priced today. So that I think it's more lucrative for buyers than to agree on a higher interest and higher price.
Yeah,
So,
I mean, I think you also what I always do too is when you're running an amortization schedule, right? So you're crafting a deal, translate that 3.5%, translate it into cash. Like pull
right,
out the
definitely.
amortization schedule and add up the total interest every year. That's how we convey it to the seller because who knows, maybe $200 a month of interest is what all they need. They'd be happy with, $2,000-3,000 a year in interest versus someone who needs 10,000. We might be able to help the person at $2,000 to $3,000 per year in interest. And we might only need to do a 2% rate for that. So
It looks like about 100 to 150,000 for 30 years on a loan about 650. I mean, on a purchase price 650. So it's a huge amount usually, about
yeah.
100,000 over 30 years, of course.
Yeah, when we're negotiating seller financing deals, we talk more in terms of total interest paid every year instead of rate. Like we don't just pound the rate. Like the rate's the rate, but we're going to tell you about how much cash you're going to be receiving on a monthly and annual basis. So yeah, correct.
Do you have some scripts how to talk to people right away, to the buyers and sellers once you find deals like that?
Kinda. I mean, not anything that I think would be like super helpful, but
Okay.
that's not at the moment.
I think it's a matter of just
Thank you.
understanding it and learning it so you know how to just convey it. You know what I mean?
Okay.
I think over time, right? You just, as you do these.
The biggest rule of thumb that with negotiating transactions, like as much as it's about me making a sweet investment, like a home run investment deal, or helping a buyer and seller, it's also about like making sure for the seller's perspective, understanding what they actually need. Like what is there's still a human behind the purchase agreement, right? Like understanding what needs they really have, what situation they're going through, and how we can craft a deal that helps them meet their needs. Like we're always trying, if you go into every conversation trying to find a win-win, I think that that's the best script anybody could have doing these types of transactions.
Okay, thank you.
Yep.
Very cool. One more real quick, Rosa, you have your hand raised. Can you, there you go.
Yes, hi everyone. This is Rosa Galarza from Nashville, Tennessee. I got a quick question regarding this because I have done some seller financing deals before and off the market property, but I ran into one that kind of was a little bit I don't know, lender was just giving us a little bit of problem. So I wanted to ask this question. Let's say seller asked for that 20% down payment from the buyer. Everything is laid out, contract conditions and things like that, the balloon payment. Now I was helping the seller purchase another home, right? They have to go somewhere. Now my seller's lender was like, well, you do have a current mortgage there and really you're doing the renting to own kind of thing. And then how do you justify that 20% a down payment that they're going to give you? Let's say in this example, $400,000 sale, $80,000 down payment. Lender was like, where are you going to justify this from? Right? So he was just giving my client a bit of a headache. And my client, honestly, at the end of the day, didn't end up wanting to proceed. We might put the house on the market next year. But I was so frustrated because I'm like, why is it that on the lending side, maybe this guy just did not know how to deal with it? And has this ever happened to you guys? And how will you guys solve this? That will be my question.
Yeah, sure. So you're saying that you had a seller
Mm-hmm.
was going to sell their home and they were going to sell it using seller financing, but needed to buy another place after as well.
Mm-hmm. Yes.
Okay. So the only thing that I can think of why the lender would not want to do that is because if there is a current mortgage on the property, which I'm assuming there was,
Mm-hmm.
yep. So when you sell on seller financing, that note does not come off your credit report.
Mm-hmm.
So it does affect your DTI, debt to income ratio, when you go qualify again, because that's considered debt on that's considered a liability, financial obligation, and monthly payments, debt. So the lender was probably trying to talk them out of doing that because they know that it would most likely inhibit their ability to purchase another property because their debt to income ratio would be too high.
Mm-hmm.
Does that make sense?
Yeah, for sure, for sure. And they did kind of have the money for, and they did qualify for like over 650.
Oh, then I would tell that lender to stay in their lane, like don't talk my clients out. Like if you're going to still get the loan, why would you talk them out of my sale?
Exactly. And like, he was just with the whole, oh, well, where are we going to justify $80,000 from? That was his whole thing.
When he
Like
said when he said justify, what does he mean justify?
Like where did this $8,000 came from in your funds, like in your savings now that after you deposit the money?
Yeah. Yeah. Oh, he's saying they're going to have to source it because they're going to use it as a down payment and they're not going to know how to source it.
Mm-hmm.
That sounds a little odd, but yeah, I mean, unfortunately, sometimes.
I think that lenders just did not have the experience when it came to that, because I've done some that are paid off, and that's not a headache. Like I have done them, I love them, I have structured them with my real estate lawyer and title company and all that stuff. But that was my first encounter dealing with one that had a loan, and a lender was just a headache, and my client was just like, "Yeah, I'll just wait for next year."
Yeah. That's too bad.
Cool.
But everything you're saying, like I've gone through it, and it's really, you're sharing valuable things, because I did it blinded. Like I didn't have no one to go to. Thank goodness I have my real estate lawyer that walked me through the whole thing. But I have done 4 of these, and thank you for all your sharing your wisdom.
Yeah, awesome.
Cool. Thanks,
I'm
Rosa.
going to show you guys this real quick before we finish up. All right. So this is what I was talking about. I'll give you an example right here, real life. Okay. Now I've been, this client, okay, they own this property right here. All right. And they just went on the market today, and we've been negotiating some seller financing transactions. Here's the issue we run into a lot in today's market. Okay. Is this person bought this house less than a year ago. So I'll show you right here, pending sale, not even barely over a year, 9/12/23 at 407. This is about what it sold for. Okay. Now it's listed for sale now for 420, but which this means is that the value hasn't gone up almost at all in the last year. Okay. Many places have not. So question for you, if you buy a property for $500,000 and then the next year it doesn't appreciate, can you sell the property for $500,000 and get your money back? No, right? It's going to be less the agent costs and closing costs, right? You're going to get 92% back. So if your property doesn't appreciate, you're going to lose money. Some people cannot afford to lose money. They don't have the funds to come to closing with, right? And so on this particular deal, this was a VA deal. So the guy got into this property for almost nothing, right? So he doesn't have the funds to cover an additional, on 420 purchase price, 12/12/24, probably roughly 30 grand. He doesn't have the $30,000 to come out of pocket. So what do? They raise the sales price to a rate that doesn't sell, right? They're going to raise it to 430, 420, because all they're doing is trying to make up the difference in closing costs versus what they bought it for. You're going to see this a lot. They bought it a year ago for almost the same amount, and then they pretty much just added up what the closing costs were going to be, threw that on top of the price, and then these properties sit. So this guy, the reason why he's open to seller financing is because he needs to move to Alaska like yesterday. He's a military guy. And so the only way for him to actually sell this property is creatively, without him having to come out of pocket with $30,000 that he doesn't have. Otherwise, there's no way, there's no other solution here. He could rent the property, but he doesn't want to be a landlord. He doesn't want to have an out-of-state rental. He doesn't want to, that's not an option for him. And so the way that we get involved in this deal is I would give him maybe $10,000, right? And I'm going to buy the property for 407. He owes 350. He owes 350 or excuse me, 399 on. He owes 400,000 on the property still. He owes 400,000. So I'm going to give him either $10,000, $15,000, and then I'm going to take over his $2,700 a month monthly payment, right? We're going to do what's called a wrap deal. Now I'm kind of moving fast through this because we don't have that much time, but this scenario, if there's anything I can let you take away today from like, how can I help clients? This right here is going to be a more and more common scenario, because you have people who have bought in the last 1, 2, 3 years and the values have not gone up. And frankly, there's no indicators right now that show us we're going to experience another 15%, 20% increase across all properties, right? So people that purchased and need to sell, however, the property hasn't appreciated enough compared to what the closing cost would be to sell it. And you're going to see these properties, everything's going to, now these photos are horrendous, but there's other, you see properties and you're looking at them and you're like, why has this deal not sold? It looks beautiful. Price seems right. And then you go comp it and you're like, oh, wait, I'm going to go to the history. Oh, they just bought this property a year or two ago. Oh, they bought it for 400. Oh, they're listed for 450, but everything is still selling for 410. And you're going to see that because all they're doing is saying, I don't have the money. I need to add to the purchase price so I can make up for the closing costs and maybe walk away with a little money, but long story short, not have to bring any money to closing. This right now is the most common scenario that we are seeing agents being able to lend an arm out to, a hand out and say, hey, I might be able to help you with this. And I can explain how seller financing works. Because many of these people, I think somebody said it before, they're not in the best scenario. Like this guy, I mean, he's not going bankrupt, but he's like, I'm moving literally 1,300 miles away and I have to go like yesterday. I don't have time to deal with this. I can't afford a $2,700 a month payment with nobody renting it. I don't want to be a property manager and I don't have the money for closing costs. What do I do? Do you see what I'm saying? That's a tough scenario to be in. And so this is where we would come in, give him some cash so he can walk away, and then we would bring we would take over, we would wrap his existing payment, and then we would usually rent this property out or we'd offer it to one of our buyers that is looking for investment properties. But yeah, this is one of the most common scenarios right now that we are seeing, and a lot of people are seeing across many markets. All right, I'm going to pause there to finish up with any last questions. We have about 5 minutes left.
It's really good, Ramon. I mean, well, it takes me back. There's so many sellers, they just don't know what to do. So they throw their hands in the air and sometimes they just walk like we're just lost. And that's where I think we can come in. If we have these tools and we understand how to do it, we can get in there and get creative and help these people, because that's what ends up happening. They just, so many of them, they don't know what to do.
Correct.
And so you see a lot of short sales. You see the foreclosures. What shouldn't have been a foreclosure. It didn't need to be a foreclosure.
Didn't need to be a foreclosure. That's right.
Yeah, and now they're carrying that around for the next, however many years. So anyway, what questions do you guys have off of that right there? And if you need to go deeper into this, if we run a little over here, we got 5 more minutes. But if we run a little over, it's not a big deal. But any questions on what he just talked about right there? Because you are going to see this a lot.
I do have a question. Can I ask?
Yep, go ahead.
Sorry, thank you so much for sharing. Can I ask a little bit more detailed question? For example, I recently talked to one gentleman who were doing things like you. So what they're doing, they're adding, like giving 5,000 or 10,000 to the seller to walk away, like you explained. But they're looking for the properties which have a lower interest, so they convey it to the potential buyer. They're also looking for a buyer who would be able to pay 50,000 above. So that's the cost of the investor to purchase that property. So do you think it's a reasonable deal? I mean, a 7-year or 5-year or 10-year balloon payment, whatever it was, I don't remember. But hopefully, property will appreciate that it will be able to be refinanced at that time. Is it safe for the buyer? Buyer probably can buy it because they probably do the credit score. Otherwise, they need seller financing, or they want that manageable monthly payment, things like that. So do you think it's a good model which I described, kind of to relate to yours?
Yeah, I mean, look, when we say like we're giving him 5-10 grand, like I truly mean giving. Like that's out of the generosity of my heart. This guy has no equity. The property is not worth, like he has no equity in the deal. So we are giving it to him. The rate is always gonna be a little bit different, but you're gonna see a lot of people who bought in the last 2 years and they walked in. This guy's at like a 6.85 rate.
Oh, I see.
So the payment's a little high. The payment's a little high. So what we would do here is I only personally will do, and again, every buyer could do what they want, but like I always recommend at least 5 years, because 5 years is enough time for something to happen with values. 2-3 years, very, very risky to say that, and even 5 is risky. That's the bottom of the risk. I prefer 10.
Yeah.
Right. But 5 is kind of my cutoff for if it's not a home run deal, I'm like, chances of it appreciating 20% in 3 years, unlikely.
So what is your interest there? You're giving him 5,000, rate is high, you're buying at the market value, taking the loan, I mean, and you holding it and you hoping to resell it in the market value?
No, anything I buy, I never sell. I hold it all. So this is going to turn into a furnished rental. And that's how we're going to get more rent for it. But then on the flip side is that this is also a tax play, right? So this is
I
going to be a
see.
property that I accelerate the depreciation on for 2024's taxes.
Understood.
There's,
Okay, so
there's,
you're looking long term. Okay,
yeah, correct.
you're not able to do multiple properties, investment properties through the bank on such conditions. So you're rather to go that route. Understood. Thank you.
Correct. Great questions.
Good stuff. Kiana, do you have another question?
That was actually pretty much my question. Yeah,
Okay.
so
Okay. Anybody else have a question on this or anything that we talked about?
I do.
Go ahead.
This is Monica from Tucson, Arizona. I have a question. I wanted to know, can you go over in detail the difference between a wrap and a subject to?
Yep. So the biggest difference is that a wrap, you are going to create a new payment. So you're going to negotiate the down payment, the purchase price, the interest rate, the amortization, and that's all going to translate to a monthly dollar amount that's due, right? It's a newly created payment based on the negotiation of terms. That's a wrap. Subject to, you are using the existing payment that's already in place. In a wrap, the new payment wraps above the existing payment. In subject to, you just have one payment.
Sorry, my dogs.
Does that make sense, Monica?
Yeah, so my other question would be, so for a wrap, do you need to have a lender involved on that one versus a subject to you could probably do on your own?
No, you don't need lenders involved in either of them.
Okay.
Yep. Yeah, because the wrap that you're talking about is a seller financing transaction, which a seller finance transaction has no need for a lender to be involved.
Cool. Anything else, guys? Kathy,
thank
Oh,
any
you.
last thoughts, comments, questions?
Well, that was great. Thanks,
Yeah, cool.
Ramon.
Thanks.
Yeah.
There's so much more levels of depth to go, but I try to keep it as surface, but also usable, I guess you should say. So hopefully you guys enjoyed that.
No, for
Yes,
sure.
sir. I
Great
just agree.
job.
Like you've got to know you've just got to know different opportunities to give your clients. I mean, that's just been probably my number one thing as long as I've been licensed is just wanting to stay on top of different creative ways. So I
Yeah.
love this stuff. Yeah. And I think it's so valuable, especially in the market we're kind of in and probably going to be for a minute.
Yeah. Agreed.
No, I think just to echo what Kathy's saying, I think it's our job. I mean, we get paid a lot of money. We get paid well on all these transactions. And in this market, again, another tool to put in the toolbox, become an expert at what you are, become a pro, in who you are in your business. And you can just help so many more people. There's no reason not to have good deals going and in the works. You got to get creative with it. It just opens up the door for that much more that we can do and more of a service that we can help people with. There's so many, I think realtors, I was reading a post, somebody this morning, it was some Facebook group I'm in and talking about how they moved to a new market. It seems like everybody there, they just look at realtors as a commodity, we're just like, we have to be there. We're just more in the way and we're making all this money and whatever, but they don't understand there are realtors out there that are just in it. Let me just get the check and on to the next deal, whatever. Like guys, if you work this and become an expert like Ramon, like what we're talking about, man,
I will die on the hill that a good real estate professional is worth their weight in gold.
100%.
The amount of calls that I get on a weekly basis of buyers, sellers, agents, investors that are asking me, "Hey, what would you do here? What would you like?" There's definitely a need for it. I agree with you, but this is like that technical knowledge that it really is a separator, right? And yeah, I couldn't agree more with, again, tool of the tool belt. That's all this is. So.
Yep, for sure.
Say, Ramon, since you opened up that doorway there, do you have your contact information for us?
Yeah,
Just in case we do want to call you with some of those questions and add to your phone calls.
Yeah, I'm easiest to find on I'll put it in the chat on Instagram. Okay.
Beautiful, man. Thank you.
That's my, here, I'll put it in there. Yeah, that's the easiest way to find me, and I will respond. I do respond to everything myself. So
Definitely.
Do you do
And
a
guys,
lot of
go
the
ahead.
DSCR loans too? Is it DSCR? Do you do
yeah,
much with that?
DSCR. Yeah, I do. For just because the ease of the process, the 20% down is kind of annoying, but the ease of the process, the rate's a little bit more, the rate's a little bit more aggressive, and there's usually a prepayment penalty depending on what state you're buying. But yeah, I mean, for properties that are going to cash flow and you're going to hold on to, I think it's a phenomenal debt product for investors. So yes, I do personally utilize it as well in addition.
Cool. So guys, thank you. Reminder, tomorrow we'll be back, same time, same Zoom link, just an open mastermind. Okay. It's always good. We'll talk about this and anything else you guys want to bring up. That's just a free for all. So that's every Wednesday. And we'll see a lot of you at EXPCon. That's coming up here pretty quick. So just a reminder on that. Ramon, thank you again. Appreciate your time so much, man. Okay.
Thank
Great
Ramon.
stuff. So
Great job.
thank you guys. Have a great day. This recording will be up probably within 24 hours. All right. We'll see you. Bye-bye.
Thank you.